High yield bonds have sold off over the past month as Treasury yields have spiked. Here to talk about whether now is the time to get rid of the junk is Wes Sparks. Welcome, Wes.
Thanks for having me. Great to be here, Greg.
All right, the yield on the JNK, which is the ETF which tracks junk bonds, is now 6.6%. That's up from below 6%. So is now the time to just sell out of your junk position?
I wouldn't disengage in the market here because actually this is the time where value is being created. There could be a buying opportunity in the very near term as we back up here and yield a little bit more. But I would also caution against using the high yield ETF as the barometer for the sector, because we do see rather large outflows from the ETFs, which is distorting valuations.
Well, I'm sorry for calling it junk. I know you high yield managers say call it high yield. But let's talk about defaults. Where's the default rate? Because that's something that you watch when you watch high yield bonds.
That's right. The default rate's been tracking at about 2.5%, well below 3%, which many managers have been expecting going forward for the next 12 months. Moody's continues to forecast about a 2.5% default rate for the next year, and we concur with that sort of outlook. So defaults aren't really a threat. That's not the issue for the market right now.
Is supply a threat? Because as rates tick up, a lot of companies probably want to get those low rates while they last.
Well, we've already seen a lot of refinancing, and actually that's been one of the primary causes of the spurt in supply that we've already seen. May actually turned out to be a record month for high yield supply. Globally, we saw over 51 billion in high yield new issues come to market. So we've already had the spurt in supply. Much of that was for refinancing, and it was issuers taking advantage of the hot market and the low all-in yields.
And what type of issuers, what are your favorite high yield issues right now?
Well, it very much is an issue selection basis that we're choosing, but certain sectors that we like, for example, are construction machinery, where there's a secular trend as well as a cyclical recovery for many of the construction equipment vendors who are selling to both non-residential and residential construction areas of the economy.
A lot of people put high yield along with their equity positions because they consider it part of equity just because of the risk perspective. And the fact is that the equity markets are selling off even when Ben Bernanke hints at tapering or he gets a question in front of Congress about when he's going to get out of the market. So tell me, what does Ben Bernanke mean to the high yield market?
Well,
I know he means everything to everybody, high yield and as well as fixed income, but in particular, high yield.
For high yield, quantitative easing has been supportive of all risk assets, and there really is the desire for the Fed to drive investors out of cash and cash equivalents and very safe investments, rekindle animal spirits, and drive investors into riskier assets to help rekindle the economy. And we've seen that in the inflation of financial asset values in equities and in high yield. Within fixed income, high yield has been the best returning asset class for the past year and year to date, even with the more recent sell-off in the last 3 weeks or so.
So does that mean it's going to come down the most if it was the best performer, because it does fall right in between bonds and stocks? Does that mean it's going to get hit the hardest?
Not necessarily, but valuations are certainly something to watch. We felt that when the U.S. high yield index fell below a 5% yield, the valuations were really stretched. We were due for a correction. We're in the midst of that. Yields have backed up about 70 basis points. And here, as we approach the 6% yield for the overall U.S. high yield index, or the market, investments are becoming attractive again. And we do think that the Fed won't actually be tapering quantitative easing, the pace of their purchases of treasuries and mortgages over the next couple of meetings. That's been the speculation in the market for the past 3 weeks. But we think the reality, you saw economic data today that was weaker than expected. It'll come down to the employment report on Friday to set the tone for the rest of the month. But we think it's more likely than not the Fed continues with its current pace of securities purchases.
All right, so people shouldn't throw out their high yield or their junk just yet. Thanks a lot, Wes.
Thank you.
And thank you for watching The Street.